Hello friends, welcome back to my channel FRM Unplugged. As promised last time, I am back with my sixth episode of the FRM case study, and today we will be talking about the case study involving one of the biggest banks in the world, which is JP Morgan. So JP Morgan episode, this scenario dates back to more than 13 years back, wherein around 2011-12, JPM had to incur a huge loss. In fact, the loss was huge in absolute terms, but it wasn't if you compare it to their balance sheet. So the loss was around $6 billion, and their balance sheet would run into some trillions of dollars. So it was not a large amount on a relative sense, but nonetheless, it was a big amount. And more importantly, why this case study is important, because this was a milestone in the regulatory journey of the various banks. And at that point of time, most of the banks were kind of pushing back on the regulations because, as per the banks, the regulations were becoming onerous on the banks. But the way this episode blew up, it showed up JP Morgan in very poor light in terms of risk policies, implementation, the risk reporting, the data integrity, and so many other things where JP Morgan was found wanting. And the name London Whale, this actually the JP Morgan's trading desk, which booked these derivative deals, they were based at London, and that is where the term London comes in the London Whale. And the bets that these desks took was enormous compared to what normal business transaction would dictate. So if the loan book would have been $100, for example, you can expect the hedges notional amount to be around $120-$130 max. But in this case, it was maybe $10,000. So obviously there was an element of speculation in it, and the amount of the deck of the deals was very large. That's where the term whale came in. So as we will see, it was a complex interplay of so many factors that led to the undoing of JP Morgan. And from this point onwards, the banks never had a choice to or chance to say no to the regulators. So all the banks across the world kind of agreed to the so-called regulatory overactivism, and it settled the debate once and for all that how much of regulatory interference is justified for the banks. So now getting into the basics and maybe digging one step more into the case study, what we would find is this deal, the losses incurred due to the deal happened in 2012, but obviously a loss of such a large amount could not be the handiwork of 1 or 2 days of activity. So it gradually had built up over last 4 or 5 years, and it started from around 2006-7, and somehow for the 3-4 years it was lying undetected, as in maybe the top management was not knowing that these many losses have been incurred by the trading desk, and when they actually got to know, they had to declare and they had to book it in their balance sheet, and that was in 2012. So this is the facts of the case. JP Morgan is a very reputed and respected name in the world of finance. Two things primarily stand out for JP Morgan, besides of course their balance sheet, which happens to be maybe fourth or fifth biggest in the world. Maybe first three or four biggest balance sheets are the Chinese banks, and then fourth or fifth would be JP Morgan. So even if we keep aside the size aspect, JP Morgan was a pioneer in risk management, having developed various risk monitoring tools like value at risk. So value at risk was a product which was developed, conceptualized by JP Morgan, and eventually this product has stood the test of time. Most banks around the world do use VAR, value at risk, in some form or the other. And secondly, JP Morgan has been an innovative bank. They had come out with a derivative product called credit default swap, which is basically a credit derivative. these were kind of misused during the global financial crisis. I mean, the misuse of this derivatives, not the derivative themselves. The misuse had resulted in the financial depression of 2008-9. Nonetheless, that CDS product was developed by JP Morgan, and it is a way where you can separate the credit risk from the credit product. So you can separate it and you can then trade the credit risk part of it. So these two were the top contributors of in the field of banking innovation, and both these innovations had come in from JP Morgan. So JP Morgan overall is a very respected name in the world of finance, and it was slightly surprising that even after all that, this bank themselves had to bear the ignominy of having their risk management system blown to smithereens and maybe booking a bomb of $6 billion in their balance sheet. They had what had happened was around 2008-9, right? The period of the global financial crisis, as we called GFC. Many of the banks were flush with funds, and some of the banks had taken a hit, but most banks were averse to lending, so they were flush with funds, and JP Morgan was no exception. For JP Morgan, the kitty had swelled further because they had taken over some financial institutions like Bear Stearns. So their total investable surplus was around $400 billion. So around $350 to $400 billion was the surplus which they had to invest. And mind you, at that point of time, the environment was not very conducive to aggressively give loans. So basically the banks have two debt instruments. One is the loan, one is the bond. So loans obviously you can't give, or maybe you will give after you kind of stabilize, you see the economy stabilizing. But on an immediate basis, the first thought that would come to the bank is to park it in bonds. So bonds is also because the bank, when they are investing in bonds, they are virtually kind of taking an exposure on the party, on the bond issuing company, because the bank is lending money, kind of, right? The bank is buying those bonds, so bank is lending money to the bond issuer. So now to deploy these funds of $400 billion, a separate desk of CIO by the name, the full form is Chief Investment Office, a separate unit was formed. It was tasked, it had two agenda basically. One was to invest the corpus very productively, and second was to reduce risk from the investment as well as from the other units of the bank. So investment wise, they were only interested with the $400 billion surplus, and for risk mitigation they were accountable for that corpus as well as the risks emanating from the other units of the bank. And at that, so they started investing in bonds, then they tried to hedge the bonds, hedge their investments, and then to, as a part of hedging, they had to cover both their positions, and eventually some of the bets became so much oversized and the focus shifted from hedging to speculating that and there were limited buyers in the market. All this contributed to the bank booking loss of around $6 billion. And finally, around 2013, so there was investigations and other things. So eventually it was found that JP Morgan had, for some reasons best known to them, the regulatory oversight was nil. The other units that were set up to keep a watch on the trading desk, they did not function properly. The model wherein you calculate the risks, that model's implementation had some failures. There were some loopholes. The IT system was not up to date. So all these things were found out conclusively by the Federal Reserve, and additional $1 billion fine was recovered from It was close to $900 million, so it's almost $1 billion. So $1 billion as a regulatory fine, at least at that point of time, was unheard of. So though it was not a big amount for a bank of the size of JP Morgan, the amount itself was huge, $1 billion, which they had to pay the fine. Now, once we look into this case, so there are few things which we need to keep in mind, which will come up in the case study. So we will first try to familiarize ourselves with those with those features, and then we can jump into the trade itself. Like, what was special about the trade? How did it lose money? So we'll get into it, but prior to that, we will go through some of the features or concepts associated with it. First of all, what is a whale? Whale is basically, imagine a person who is betting in a casino. So if so the person who is betting in a casino is nothing less than a gambler, right? So see, it is not to disrespect the bank's traders by referring to them as gambler, but the kind of mindset that was displayed by those traders were just akin to a gambler. So they were just wearing the hat of a cowboy banking with gambling kind of an agenda, not the conservative risk management hedging kind of a mindset. So when a person is gambling in a casino, so the first time he puts a bet, right, and he wins it. Now he wins big time. Now and if he stops betting after he wins, then the casino can never recover its losses. So the casino can recover its losses only when this gambler increases his number of chances of playing. And secondly, the mindset of a gambler is, if I have lost the first round for $100, let's say the bet was for $1,000 and I lost it by $100. So the mindset is, and the actual requirement also is, that if I have to recoup the losses of $100, I have to increase my second bet to the tune of $2,000. So earlier bet was 1,000, second was 2,000. So this is a kind of a trap we all understand, right? So this is an unending black hole where you can get sucked into. So this is a gambler's whale's mindset that we are talking about. And the rationale behind the big deals was, these guys would have probably anticipated that there may be increase in demand of some of the credit derivative instruments. So it had bought those in huge amounts. Unfortunately, interest was not generated, or people were not very receptive to this product. So the demands had petered out, and it was laden with so much of the deal CDS that they had to offload it in losses. So that's how this term whale is coming in. There is another concept of Basel III. So Basel is a city in Switzerland where most of the banking regulations related to capital requirements are there. So there is a requirement for credit, there is a credit risk, there is a requirement for operational risk, there is a requirement for market risk. Now, so likewise, Basel I, II, these things were formulated, and these are not legally enforceable, but these are a kind of a guideline, and it is up to the jurisdiction central bank to recommend it to their bank. So in case of India, we will have Reserve Bank, which will issue notification for the bank abide by the guidelines of Basel III. So the main feature of Basel III was, so up to Basel II, if Bank A and Bank B were there, both had $100 as mortgages, right? But Bank A's $100 mortgage was only to AAA rated borrowers. But Bank B's $100 mortgage, out of $100, $50 was to AAA rated and another $50 was to AA minus. So Bank B, even though it is having slightly more riskier assets, still bank A and bank B both would be required to keep, let's say, $9. I'm just giving a ballpark figure, 9% of 100, 9%. So $9 both the banks would have to keep as per Basel 2. Basel 3 slightly changed it. So as per Basel 3, bank A would still be required to keep $9, but bank B would require to keep, for the first $50, it would require $4.5, and for the next $50, it may require $6, just because the risk is higher. So if the risk of the borrower is higher, obviously he can default. So I have to keep additional capital. So bank B will be required to keep around $10.5, and bank A is $9. So now what had happened here, how this is impacting the London Whale case is, once the deal size, the derivative positions became very big, and it was around 2011-12 that Basel 3 had kicked in. So as a business, everybody would like to do the business with bare minimum capital, right? So JPM was also in a mad rush to reduce capital, or rather not to have the inflated capital lying unused in its balance sheet. So one way of doing it was to pare down the risk-weighted assets. So they wanted to close out the open positions that this derivative desk had booked, because as per Basel 3, even derivative deals and this kind of complex derivative deals would have attracted capital of maybe 160 to 170%. So obviously those were an insane amount. So they wanted to reduce the capital requirements. So they wanted to cut down those derivative positions, which forced the bank to sell those derivatives in a loss, just because the deal size was so huge. And since these were over the counter kind of a derivative, so there were not enough buyers. So it was like only a limited buyers, and whatever price they had agreed, the JPM was forced to sell on that. So this is how Basel 3 is coming into the London Whale issue. And then there is the concept of the credit default swaps. So credit default swap is a credit derivative instruments. They are usually called synthetic credit products. Why synthetic? So normally if you take the case of a regular derivative like futures or options, the value of the futures or options is totally dependent on the value of the underlying instrument, underlying share, which is in this case equity, let's say any share. So as per the value of the share, the price of the futures or options fluctuate. But in case of credit derivatives, the price of the credit derivative so credit default swap is a type of credit derivative. So the price of the CDS is totally dependent on the probability of the credit event, which is, let's say, on the probability of default. That is why it is called synthetic. So the price of the CDS does not depend on the price of the debt instrument, which is a loan or a bond. It depends on the probability that the bond issuer or the loan taker may default. So, and this credit default swaps, these are kind of a credit insurance. So just like we have vehicle or property or life insurance, similar way these banks also have credit insurance, which insures the bank against the risks of non-payment. So banks need to, so the insurance seller will usually be some big financial institutions like, let's say, AIG. So, and if JP Morgan is buying insurance from AIG, like we pay insurance premium, JP Morgan would be paying something called as spread. So the spread means the premium. Spread is, so the premium is usually expressed as a percentage. So if I am purchasing an insurance for $100, I may have to pay $4%. So this 4% is the spread, which is the premium. So the bank which is buying will pay the premium, and there are certain credit events that are defined in the contract. So for like example, when we have a vehicle insurance, only if the vehicle meets an accident will the insurer pay me. Similarly here there are some events defined. So if the bond issuer has a credit downgrade, which means if he was AAA plus and he is now BB, So in that is one scenario, or he becomes bankrupt. In these kind of scenarios, there will be payout from AIG to JP Morgan. And if everything remains the same, then JP Morgan doesn't get anything in return. It just pays premium to be insured from the credit risk. And so the party now, there are two things. The banks can hedge their risk by buying this credit protection, and banks can also do some speculation. So how will the bank do a speculation is, if the bank, now there is one difference between the vehicle insurance and the credit insurance. So for vehicle insurance, if I have to buy an insurance on a Mercedes car, I have to own that Mercedes car, right? I cannot buy insurance on someone else's Mercedes car. But in case of credit derivatives, you can buy credit insurance on a debt instrument which may not be to you. So that is where the speculation comes in. And so how it happens is, say today I am buying the credit insurance on maybe let's say I'm buying the credit insurance on Amazon today. So with time, so let's say Amazon has issued bonds to some other banks, but since I am a speculator, I need not buy those bonds, but I can still buy the credit protection. And if I have taken a credit protection on a 5-year bond, then the probability of default on day 0 is less than probability of default on year 3, because with time probability of default increases, and once the probability of default increases, then the risk premiums also shoot up, right? We all know that during COVID, since our claims became more post-COVID, the insurance premium for health shot up quite a bit. So similarly, when the probability of default increases, then the JP Morgan can offload the CDS by selling it at a premium and booking the profit. So this is a speculation part of it, and banks are legally allowed to do speculation. There are certain rules which is covered in Volcker that we'll see. Volcker rule. Now there was a gentleman by the name of Paul Volcker. He was the chairman of the US Federal Reserve in the early 80s, and he post the global financial crisis, Volcker had proposed this, had proposed the, what should I say, the rule that a bank which is being funded by taxpayers' money, which means me, you, we are kind of funding the bank by putting our savings or deposits now, and these deposits are also insured by FDIC up to $250,000. Now, if the bank is being funded by taxpayers, then the bank is prohibited to use proprietary trading with taxpayers' money. Proprietary trading means speculation. So bank is not supposed to do speculation. If JP Morgan has to do speculation, it has to do it through a separate entity, which is an investment bank. So investment bank source of fund is not taxpayers' money, it is something else. So Volcker clearly stated that this distinction has to be there. You can't take customers' money just like that and do speculation, because speculation is a wild gambling bets, right? So that was Volcker. So it eventually, why this rule is coming here is basically because it was eventually found out that JP Morgan was kind of indulging in activity which ran counter to the Volcker rule, and Volcker rule was kind of it was a political decision by the then President Obama. So, and that's why it got more mileage than it maybe deserved at that point of time. And one final thing that we just discussed also some time back was the value at risk. So value at risk is also a tool that was pioneered by JP Morgan, and ironically it was found that JP Morgan's VAR implementation model had some implementational error, which resulted in wild fluctuations in the VAR value, and there was no determined way where you can find out the value at risk. So value at risk is basically the probability that the bank will have a loss within a certain time frame. So var of, let's say, it could be, let's say, at with 95%. So we all know the bell curve, right? So in the bell curve on the left hand side is the risk, is the extreme events, and on the right hand side is the, so on the left hand side are the negative extreme events, and on the right hand side it's the positive extreme events. So the left hand side up to, let's say, 95% or 99%, if you plot the bank's risk on a bell, on a x and y axis, it will resemble a bell shaped curve with, and you the area to the left of, let's say, maybe 95% or 99%, that gives the probability that the bank will incur a loss. So I mean, VAR in itself is a very big literature, but I think for the purpose of this case study, if we remember this much, that should be fine. Now this is the basic reason behind the deal. So we already discussed it some time back. So they were flush with funds and they wanted to kind of invest it, and they were also tasked with doing the credit risk hedging. So that, so, and there was a CIO unit that was set up. There was a very senior person who was recruited, and she was made in charge of the CIO by the name Ina Drew. And in her team, there was a trader operating out of London by the name of Bruno Ixil. That guy was the one who was kind of putting in very big bets, and their competitors used to call him London Whale. So Ina Drew took charge of that CIO, and this is what is called as a synthetic credit. So we discussed some time back why the name synthetic is coming. So, and they started this operation sometime around 2007-8 types, just at the starting of the, when the recession was happening. And eventually by 2010, so initially it was in a very small scale and it was not a very noticeable, but subsequently, so JP Morgan had some idea that there will be more funds that would come in regardless of the financial crisis, and only the financial crisis accelerated the increase in corpus. JP Morgan would have anyways had a good corpus to invest. Now what was basically the trade? So now one point that so we can only do hindsighting, and there is a possibility that all the facts would not have come out, though Federal Reserve had done their, what should I say, analysis, and they had done all kinds of examination, but still we can't be 100% sure what happened, how it happened, what was the sequence of events. But going by the circumstantial evidence, this is how it appears the incidents would have panned out. The first trade was, these guys bought protection against a very, what should for credit default swap, either you can buy the CDS on a specific bond issuer, which is a specific corporate, or you can also buy the protection from a credit index. Just for the credit index is a very complicated thing to explain in a short video, but just keep this in mind that the credit index is a representation of the underlying companies that make up that index. Just like we have S&P 500. Similar, so S&P 500 mirrors what is happening in the 500 corporates. Nifty 100 mirrors what is happening in the 100 stocks attached to it. Similar way, for the credit default indices, it mirrors what is happening with the companies attached to it. So there is something called as CDX North American High Yield Bond. So HY stands for high yield. So high yield means rate is higher, so which means it is more risky. So it is assumed that 350 or 400 billion dollar, no, out of it a substantial amount was invested in this, and since they were risky, see, JP Morgan wanted to earn more, right? So they invested for more returns, but at the same time, to hedge against this companies defaulting, they bought credit protection. This worked well, and in 2009, I think 2009 or 10, it generated a revenue of $1 billion, which is a large amount for a credit default swap transaction. That much of a revenue is unheard of. So now there are various lapses that we will come. See, if you are kind of doing a very normal transaction and you get a super normal profit, won't the supervisors try to kind of dig in and find out how come this much high profit has come in? But somehow, for reasons best known to them, they decided not to investigate. They were just happy with the $1 billion. And those $1 billion had come because of some additional windfall, like General Motors had declared bankruptcy. General Motors was one of the companies on that CDX index. So JP Morgan received a good payout, and for the other corporates, with time, obviously, like we mentioned, their risk ratings were further kind of slowly went down, and they also earned some amount by selling their CDS at a higher premium. So all this while, it was a gravy train and people were happy. Now at one point, 2010-11, the worldwide, the waters were calm all over the world, and most of the economists had of the opinion that things are now back to normal and that choppy waters are no more there. So the first trade one, that started losing money because you have just hedged it. I mean, you have just bought protection, and so when you are buying protection, you are betting for the economy to go down. That is why you have bought it, right? Now the economy stays like that, or economy even further improves, then this trade one is worthless, right? And you have invested billions of dollars buying that insurance. So they were kind of around 2012, they were asked to cut down these positions of trade one. Now these guys at CIO, since they were so much used to kind of profit, they could not take their eyes off profit. So what they did was, instead of cutting down on trade one, they doubled down and they increased their exposure by having an offsetting deal as trade two. So what is trade? So trade two is just like in the first scenario, they bought insurance, here they were selling insurance. So now what happened is, when you are selling insurance, you are betting for the economy to go up, right? So if I am selling insurance and if the economy goes up, then there is no way my customers would ever come to me for any payout, right? So I can coolly pocket that premium. So that is how this trade 2 came in. So trade 1 and trade 2 are just opposite. So trade 1 you are buying protection, trade 2 you are selling protection. On a definitely this was on another kind of a what should I say, some less risky bond. So the first one was HY bond, which is high yield, high risk bond, and the second trade was on what do you call IG, investment grade. So investment grade is good. So basically you are betting that the economy will improve. So if the economy improves and I have sold, then there is no question of claims, and whatever premium I am getting, I am straight away booking. So trade 1 was giving losses and trade 2 was giving income. But since the trade 1's size was very huge, the losses of trade 1 were never possible to be compensated by the profits of trade 2. And they just as an additional so when trade 2 was found to be insufficient to account for the losses of trade 1, they started doing a trade 3 where they again invested in some additional investment grade bonds, and they bought protection on those investment grade bonds. So because there was some issues related to some of the companies where the bank had an exposure on, so they thought that okay, we'll buy some insurance so that there is no big time loss for the bank. And since we were since the JP Morgan was cutting down on trade one, no, and few of the trades which were supposed to be renewed were not getting renewed. So just as a stopgap measure, they thought that trade three would kind of fill in the gap, so to speak, in a very crude way. Trade one, they were kind of winding up slowly, but they were incurring losses. Trade two, they were not winding up, they were earning profit, but not much. Trade three was added to supplement trade two, but it didn't. So the trade three was not a revenue earner, but it was a stopping. It could stop the payouts by buying insurance. Eventually, all these three trades resulted in it could not arrest the accumulation of losses, and at one point of time they had to incur around $6 billion of loss, which it was booked in the balance sheet. Now, if we see this checkered course of the trades, no, so like we mentioned that the trade one, so people never questioned where from this $1 billion came in. So $1 billion came in on account of General Motors bankruptcy. Thereafter, some good income had come in due to American Airlines bankruptcy. So, and if had this American Airlines being declared bankrupt a few days after it actually declared, then this income would not have come. So all these warning signals went unheeded, and nobody bothered to check or do analysis of the results. Now, when you actually do these kind of trades, no, and you are asked to cut down, you need to actually. So it is between the devil and the deep sea. Once see trade one, if you have to see trade one, they slowly cut the exposures, but not to the extent the management would have wanted. So the obvious reason was, since it was a loss making to cut the deal, they were reluctant. But at some point, you have to bite the bullet. Instead of that, they thought that okay, let us delay it and let us have an offsetting trade. That is what they did. Instead of kind of selling that portfolio, they doubled down on it and they added a second leg, which is like we mentioned, trade two. Eventually, all these did not kind of what should I say, recover the losses that was there on account of trade one. And a few of the to make matters worse, no, Kodak also filed for bankruptcy. Now, for General Motors and American Airlines, JP Morgan was safe because it had renewed those CDSs and they could get the payout. But in this case, in the case of Kodak, there, so every year you have to, means once the maturity is over, you have to renew it. Due to trade one getting pared down, they could not renew the contract of Kodak, with the result that when Kodak filed for bankruptcy, they had to, since they did not buy their insurance, they had to pay a good amount for the Kodak bankruptcy. All this resulted in a huge loss, and that is how that $6 billion came in. So if we look at how the basic reasons for why JPM failed, so the main reason why it failed was model error. So what is a model error? Model error is an error either in assumption or in implementation. So unlike the case of the previous case studies of Silicon Valley Bank or Metal Gesell Shaft, here in Silicon Valley and Metal Gesell Shaft, the external market variables moved in an adverse manner. But in this case, there was no contribution of the external environment. Their internal failed checks and controls, the way they calculated the risks, the way they took wild bets without understanding the strategic purpose of the SCP, so to speak. all these things contributed to the running up of losses. Otherwise, at so we whenever we invest in shares, there is something called as a stop loss, right? That if share price falls below this, or at if I book up to this much loss, I can take. Beyond that, I have to kind of square off my deal. My deal will be closed. I will not take any loss more than that. Similar thing existed in this bank also. Even a very small bank will also have it. So such a large bank should have had it, and they had it, but maybe they would have suppressed it. People above did not. So the stop loss was, I think, $50 million, wherein they were raking in losses of more than 100 $200 million. So obviously all these factors contributed to the loss of $6 billion. And like we mentioned, this this incident actually sealed the fate of the banks. And even now, if you look at the latest Basel regulations, most of the banks are forced. See, if you have to make money, good money, then you have to step out of your comfort zone of loans, and you have to get into this kind of speculative deals if you have to have that kind of money. And for speculative to have a speculative transaction done, you have to keep enormous amount of capital, which is a drain on the bank's resources. But somehow with this deal, with this fiasco, so to speak, the banks have no choice but to keep large amounts of capital for the speculation purpose, which continues till date. So anyways, that's all about the case study of JP Morgan. So if you look at any literature on JP Morgan, you will find very varied and conflicting assumptions or descriptions. It is very difficult to pinpoint what actually happened, and most of the literature of FRM, including the normal books that comes in, you will never find this kind of details mentioned anywhere. It will just have a high level mention that okay, it was a model failure, only this happened and that. It never went into these kind of details of the trades that were doing, what the trade one was doing, why was trade 2 taken in, why trade 3 had come in, what was the rationale behind the CIO. These things you would never find in the normal books, and I hope you will find this useful, because this is one of the very practical applications of the credit default swap. In case you have any queries, you can consider putting your comments or queries in the YouTube link. And in case you found this to be useful, do consider liking and subscribing to it. It would mean a lot to me. I will shortly come up with the 7th in the series of FRM case studies soon. Thank you.